Venugopal is here with us. Venugopal, good afternoon. Thank you so much for your time. You're making a case for moderating of expectations because the rally has actually played out in a very decent measure. In your latest note, what kind of communication are you sending out to your investor fraternity and also to our viewers right now for the rest of the year? What are the possibilities, the way good news is getting baked in? Say, for example, Nifty, just for indicative purposes, what kind of returns do you expect in rest of the year in 21?
Thank you, Ajaya. So 2021, this calendar year, I think one of the tougher aspects of this year is that to a large extent, the easy, gains and easy trades are done, right? So I don't think it's any more a surprise that macro is going to normalize at some stage. So what it means also is that from a valuations perspective, it might appear challenging, if one were to try to build new positions here. But at the same time, I would say that, liquidity, global liquidity, as well as macro sustaining in terms of a turn are very important variables, because till the time you don't really see macro peaking, I think there would still be some degree of positivity in the markets. So the way we looked at this year is, despite our general discomfort, around valuations and things like that, we said, look, macro peaking is potentially possible only in a couple of quarters from now. So if that is the case, there is probably still room for earnings momentum to continue. And hence, we should be constructive on the markets, at least in the first half of the year. Because when I looked at the full year numbers, we use very traditional approaches to giving sort of Nifty targets. We said, look, we're probably looking at single digit returns as far as a point-to-point forecast are concerned. But maybe that is not a very material or substantive data point for anyone. So the other approach was to primarily look at directional view. Directionally, we are still positive, in terms of opportunities that one can participate in the market. And we also think in the first half of this calendar year, probably the market could overshoot the target. So that's the way we are approaching it. One very quick thing here is, look, whenever you tend to see a fairly quick up move in the market, you tend to also worry about corrections. Corrections tend to be fairly common. So one of the exercises we did, which we published in a report too, is that when we looked at almost every downturn and looked at the 6, 12, 18 and 24-month period from the bottom, what we realized that in every 6-month period, if we were to look at it, almost 35% to 40% of trading days were actually negative trading days. And the rebounds, in particular weeks when we had large negative cuts were very quick. So I think we're still in that stage, at least in the first half of the year.
Right. Very good observation, Venugopal, I must say. Let's shift focus and talk about the quality of earnings which are starting to pour in. A small patch has come in by now, but last quarter too, in the second quarter, the numbers were fairly good. In fact, there was the first time we actually saw upgrades come in last quarter. Whether this will continue this quarter or not is something to watch out for. What are your expectations? And do you see our universe or the stocks universe that you cover on a durable earnings upgrade cycle?
The approach that we used for this was, again, different time frames. One was the near-term time frame, which is this quarter or maybe the next quarter. And the second thing is, what is consensus building in across sectors for the next 2 years? One thing is very clear. If you look at earnings across the board in terms of consensus forecast, you will see broad-based earnings growth. This is not about a particular sector driving earnings. It's like across the board 20-30% growth, and understandable because you have a very particularly supportive base. But the interesting thing is, if I look at near term, it's extremely challenging to figure out the level of distortion in the economy, which could play up in earnings. This is not about negative distortion. It could be positive distortion as well. And the reason is, when you're moving, pretty much, from a normal, in a normalized fashion into a higher macro level in terms of absolute GDP base from a lower level, what tends to happen is a lot of actions in the market tend to reflect. For example, that one sees demand coming up, the channel says, oh, I need to restock. So suddenly you'll probably realize that December quarter volumes might be much larger than what you have thought. The second thing, which is a level of distortion, is margins. which is probably in our view, in the near term, going to be very supportive. And that's because a lot of these cost actions, I would say, or the cost areas which companies would have identified during the COVID phase, those benefits are going to last for a while. And this is not a perpetual lasting. I think probably 2 to 3 quarters from now, that will get frittered away, because in a normalized economy, everything comes back. New products have to be launched, you have to do advertising, you tend to see competitive activity come back, you tend to see supply chains fully back in shape. So even a tier 4 player is, essentially, pushing to, sell his product. So those advantages go away. But near term, I think we're generally positive on, the scope for earnings to look attractive relative to expectations. Now, this may not really change, probably in FY23 forecast, but the street might want to upgrade it today just to reflect the positivity. That could be the risk. And that's what we need to see 6 months later is, are people building in froth in FY23 numbers because of what you're seeing today?
Right. Venugopal, I was just looking at the component of Nifty EPS for FY22-23. A large component of it is actually coming from Reliance Industries, obviously because of the weight as well. But I reckon that the big part of the earnings actually contribution starts coming in a couple of quarters from now. How much of that is already being priced in, and how do you see that? Because, there was a very big outperformance from Reliance, which also pulled the markets higher, and then it went into sideways. Today, of course, it's trading 1% higher. But the relationship of Reliance to the front line is very important, and how, the earnings of this company will actually move going forward for a wider reason.
Yeah, you're right. Given that it's a large weight, probably it might appear that it's, sort of driving the overall, earnings. But we actually looked at sector to sector for NSE 200 stocks, just to give a context of, each of the sectors as to where earnings growth would be. See, Reliance Street is looking at almost a 50% jump in earnings. And to an extent, it appears to be more about recovery in a couple of their end markets, including telecom, which is a big driver, for the numbers. Somewhere down the line, of course, it is also an expectation of, ARPU increases, which probably are also potentially baked into how one looks at Bharti too, in terms of a stock. The point is this, that, Reliance, beyond a certain stage, if I were to look at the drivers, I think are more about their ability to execute new economy enterprise. That, I think the benefits of that are, of course, going to trickle in 1 year, 2 to 3 years later. But what they do from here in the next 1 to 2 years are going to be closely watched, more in terms of, the level of returns you can generate from here. The way we looked at Reliance is this, that since we were generally very positive on new economy enterprises, we said, look, what is the incremental news flow that could come in beyond earnings? The only other incremental news flow is that from a tech point of view, you're going to see a lot of IPOs, sort of kickstarting. Now, looking at how, the IPO world is, even in the global scheme of things for tech, I think there would be generally a very positive excitement around the opportunity. And this is potentially what is going to protect downside from here for Reliance. So that's a simplest case, if I were to look at it. Though it's in our portfolio and we are looking at returns larger than what we have for index. Since our index returns itself are, not very large. In that context, Reliance fits in for us, both from an earnings as well as, a thematic point of view at this juncture. And last 6 months is actually underperformed. I think after August, it's been trading, sideways for a lot of reasons.
Intraday. Right. Venugopal, what are the other changes which you have done in your model portfolio where you believe the valuations are relatively attractive right now, and the earnings trajectory 12-24 months could actually be on the higher side, and there's scope for surprises as well?
Yeah, so one of the key things here is about, from a year perspective, it is about which stocks have not done well or which sectors have not done well. I think that was the simplest way to look at, opportunities. So what we've done through the year, so this model portfolio update, of course, we did a month ahead of our outlook, but what we did there is probably we added a bit more of financials, and we also, added Bharti, which was, removed from our portfolio about 6-8 months back. So in some sense, if you were to look at it, these were individual opportunities or, that we were taking. But if I were to look at the flavor of the portfolio and how it has changed over the year, we have primarily, focused a bit more weights towards the recovery sectors, which is financials, construction, or even the urban place, which could be even something like a PVR, for example. Because the next thing in our view that is going to perform, is probably going to be these end markets. At the same time, we have maintained tech as a core because, all the positivity that we see for tech, so we needed to have some core. So that's how we are sort of playing this. Of course, I think investors would have much broader options, in terms of playing, small gaps within sectors, for example. So so those things we don't really
seen in this environment, the way liquidity is, the way rates are low, the way global macros are panning out, is it fair to look at PE alone and call it expensive or inexpensive compared to previous cycles?
Yeah, that's a very good question. The way we have usually approached it is, we have tried to look at implied free cash growth based on the new paradigm of WACC, which is factoring in the lower risk-free and, So in that construct, there are certain sectors, for example, IT, which doesn't look costly to us. IT looks costly in P, compared to history. But on implied free cash growth, it doesn't. So if I were to put this argument for across the board for the market, yes, you do have some leeway compared to probably the near-term history in terms of why price to earnings should be slightly more elevated. But then the key thing is this, that price to earnings, from a context of a very long-term history or also at the peak, so we have seen this sort of liquidity environments even in the past. So there have been at least a couple of episodes where the environment and setting probably was very similar. So even in that context, it's costlier from that perspective. But I would argue that we've never seen a situation like last year where a couple of months there was hardly any activity in the economy, right? So what it means is the earnings rebound potential and the sustainability and the strength of that probably is more tenable this time as compared to probably in the past. So that's the other way to approach it, that probably we're using the right EPS numbers when we look at a PE, and maybe there's less risk for correction, at least in the next 6 to 12 months from an EPS perspective.
Right. All right, Venugopal, we'll let you go on that one. Thanks so much for joining us today. I always appreciate your inputs and contribution on the show. Thank you so much.
Thank you.
With that big voice, let's take a short break on the show. More news and exclusive analysis on the other side. Don't go anywhere.